Forex trading operates on currency pairs, where traders attempt to profit from the price movements between two currencies. At the heart of every Forex trade lies the concept of the spread. Imagine walking into a bustling market and finding various stalls selling identical apples. Some offer a lower price if you buy, but if you wish to sell your apple back to them, they offer a lower price still. This difference in buying and selling prices is similar to the Forex spread. In Forex, currencies are always quoted in pairs, such as euro to US dollar. When you look at a Forex quote, you see two prices, the bid and the ask. The bid is the price at which the market or your broker is willing to buy the base currency in exchange for the quote currency. The ask is the price at which the broker will sell you the base currency for the quote currency. For example, if euro to US dollar is quoted at 1.1040/1.1042, you can sell at 1.1040 bid or buy at 1.1042 ask. The difference between these two prices, in this case 0.0002 or 2 pips, is known as the spread. The spread plays a crucial role in Forex trading because it represents the transaction cost for the trader. Brokers have to earn revenue for providing trading services, and instead of commissions, most Forex brokers incorporate these costs in the spread. For the trader, this means you begin your trade slightly in the negative, as if you bought an apple and had to wait for the price to rise even before making a profit. There are two main types of spreads: fixed and variable. Fixed spreads remain constant regardless of market conditions, which can be advantageous during volatile times, as they provide predictability. Variable spreads fluctuate with market supply and demand. During major news events or high volatility, variable spreads can widen, thus increasing trading costs. Several factors influence the size of the spread. Highly traded currency pairs, like euro to US dollar and US dollar to Japanese yen, usually have the smallest spreads due to high liquidity. Exotic pairs, which are less traded, tend to have larger spreads, reflecting higher risk and lower liquidity. Time of day matters as well. During the overlap of the London and New York sessions, spreads narrow due to increased market participation. Traders should always be aware of spreads when planning trades. Narrow spreads are ideal for scalpers who aim for small, quick profits, while wider spreads may not affect long-term traders as much. Some brokers offer zero or very tight spreads, but may compensate by charging a fixed commission per trade. Understanding spreads helps traders manage their costs and choose suitable brokers and trading times. It is a fundamental piece of the Forex puzzle, subtly influencing strategy and ultimately profit potential in the global currency market.